Hello, Rajaram sir, are you able to hear me? Good evening. Good evening, all. We will start today's session. Whether my voice is audible?
Yes, ma'am.
Actually, Rajaram sir, I am not able to hear. Please ping me on Teams chat, sir. It's very voice is very low. I am not able to hear. screen is okay. So the screen now till yesterday what we were seeing is the rules from in the valuation chapter. We were discussing about the all these sections and these rules. So the section is related to the 15 section 51 1 52 15 2a 2b 2c. These sections are when the market value, when we know all the transaction values, then we were considering the section 15.1, 15.2a, 2c, 2d and e. Now why we moved on to the rules? When you are not, when the transaction value is not available. So what is the transaction value, or you can call it as a taxable value of supply. If these two the values are not available, then we have to follow the section 15.4. That is section 15.4 has 4 rules, that is rule 27, 28, 29, 30 and 31. And yesterday we have also seen rule 27. So in rule 27 also we have 4 different conditions, that is 4 different checks we need to do. One is what is the open market value. Second one is related to if partially in money and partially in kind. So in that case how we need to calculate the transaction value. And the third one, similar kind and quality is there. So based on that we were checking the transaction value. So we have still 28, 29, 30 and 31. And we will first discuss about the other few things, so then it will be easy to come back to these rules. So I am moving on to the few simple problems, then we will come back to this rule 28 now. Rajaram sir, I think for you it is a long gap in our class. So this is related to the valuation topic. We were discussing few of the things, and now the one which we are going to see, it is a very new only. It is nothing to linked with any of the previous ones. So once you have a look on this topic, then I can go back to rule 28, 29, 30 and 31 yet to complete. So you will get an idea what exactly is there in the valuation, GST valuation. So in book, this is just from the study material only. So I am in rule 31A. So rule 31A is about value of supply in case of lottery, betting, gambling and horse racing. So we are into rule 31A, and in this chapter we are studying only about on what value we should calculate the GST. So that we call it as a transaction value or taxable value of supply. So in this particular case, That is, in case of lottery, betting, gambling and horse racing, how you will be finding the transaction value and on what value GST is calculated. So this is the as per rule 31A. So we have supply of lottery run by state government or supply of lottery authorized by state government. So the value is higher of the two amounts to be deemed as value. 100 by 128 of the face value of the ticket or 100 by 128 that is notified in the official gazette by the organizing state. 100% of the second issue is supply of actionable claim in the form of chance to win in betting, gambling in a race club. That is 100% of the face value of the bet or amount paid into totalizator. So the section that rule says what value you should consider. So it will be the supply of lottery run by the state government or authorized by the state government. So whichever value is high, then will on that value will be that is 100 by 128 into the state government or authorized by the state government. So these two we have to consider. So in our material we don't have this, I have taken from the other material. The government of a state, so the same only we are seeing in the example as an example. The government of a state runs a lottery where face value of lottery ticket is 250. So it is the state government and they runs a lottery, the face value is 250 and the price notified by the state government in the official gazette it is 240. So the value of lottery is 195. So that is higher. How we are derived? This is directly, answer is directly given, which is 195. So how this 195 is derived? So the 250 of the state government, that is face value of the lottery ticket or the price notified in the official gazette. So the two prices we have considered into 100 by 128. So whichever is higher, that will be our transaction value. On this value only GST is applicable. Same, the similar example only below as well. This runs a lottery where the face value is 250 and the price notified by the state government is 260. So we need to remember this, which is 100 by 128 or the notified in the official gazette 100, whichever is higher. The same we need to calculate. And then we have from rule 27 to 31, which is related to where the transaction value is not available, how we need to calculate the transaction value. Apart from that, there are other certain supplies also there. So that certain supplies means it includes this lottery, betting and gambling. And we have rule 32 to subsection 3 and subsection 4. Subsection 2 is for money changing services and 3 air travel agent and 4 is for life insurance business. So we can see the similar thing here, like what is the purchase or sale of foreign currency including money changing. These are the services are there. And the booking of tickets for air travel by an air travel agent. So suppose if I am suppose if I started some business, my own business as a agent, air travel agent, in that case how I will on what value or what are the transactions which I need to consider to pay the GST. That is how I will derive the taxable value of supply, on which value I have to pay the GST. So the section clearly gives the case, the conditions. So what are the things we need to consider to derive the taxable value of supply. So we have apart from the previous section, rule 31, there are few rules, and in that few rules we are seeing multiple, that is different supplies. So in that, one is money changing services, then tickets for air travel by an air travel agent, then life insurance business, then we have value of supply of second hand goods. So suppose if I started as business of buying and selling of second hand goods, in that case on what value I have to pay the GST. Then redeemable vouchers, the value of redeemable vouchers or stamps or coupons or tokens. So these are the few other supplies we need to understand how the transaction or the taxable value is calculated. So first one is, we are in rule 32 sub-rule 2. So first we will see about money changing services. So under money changing services, so first we will see what is the meaning of it. So the currency exchange is a licensed business that allows the customers to exchange one currency for another. So today I have to travel to London and I have Indian currency, but I need to change into US dollar or UK pound. So in that case, where I will go, I will have to go to this teller station and I have to exchange the INR into the respective currencies, country currencies. So that for that type of services, how we have to calculate the transaction value. So now we are into rule 32.2. So under 32.2, this is from our material only. So the money exchange service, at the option, there are two options are there. Either you can go with the rule 32.2a or we can follow rule 32.2b. So if we are following rule 32.2a, we have different types of scenarios like case 1, case 2, case 3 are there. So in case 1, it is clearly given, if you have the actual exchange is 62 rupees, where the RBI exchange rate is this much, on the difference you need to see the USD currency, and that on that value only you need to pay the GST. That will be our taxable supply. So please have a look on these three different scenarios. Based on that similar only we will be seeing in the problem also. So in under case 2, so in case 1, if RBI exchange rate is given in the problem, how we have to calculate the taxable supply. If RBI exchange rate is not given, in that scenario, how we need to calculate the taxable supply. In the third scenario, it is cross currency. So USD is this much and UK is 80,000. Then how we need to derive the taxable supply. So there are three different scenarios which is for the money exchange service. So for the so once we have become we are doing our practice, and one of our customer is doing this money exchange services. So in that time we should have a good knowledge. So like on what value he has raised the invoice, whether on the correct how our customer has calculated the taxable value, on the right value only, whether he has started paying the GST. So those things, if we want to check, we need to understand these criterias. So first 32 sub rule 2a we will see now. So in problem, if you see, we will get some idea about what that section 2a says. On 25th July, X located in Chennai converted US dollar 100 into INR. Actual exchange rate INR 62 per USD through Akbar Travel, a money exchanger. RBI's reference rate for buying and selling was 61, that is 61.5 respectively on such a date. Akbar Travel registered under GST and located at Chennai. Find the value of supply. In the question it is directly given that we need to use the rule 32 2a and the GST of the CGST rules and the GST also. So we need to see what is the GST he is liable to pay, where the address of the recipient is available with the supplier. Then how much GST liable to pay in case RBI reference rate is not available. It is the same what now we are seeing in the problem. This is the same rule only we are going to follow. So we know it, the actual exchange rate is 62 and the RBI is 61. So $1 is there. On one, for how many, that is for what value of USD the X Limited is converting? He is converting this $100. So 100 into 1. So the taxable value, that is value of taxable supply is 100 rupees and GST will be levied on this amount. So generally what happens, suppose if he is some customer comes and he wants to convert $100 into INR. So what we do, directly 62 into 100, so 6,200, and we will be calculating the GST on 6,200. So we will be calculating the GST on 6,200. But the rule clearly says what is the value you need to consider here exactly. So you know the exchange rate, the actual exchange rate, we know it, and RBI exchange rate, we know it. So RBI exchange rate, there are two are there. So which one we have to consider? You will get confusion, like RBI reference rate for buying and selling. So 61 is for buying and 61.5 is for selling. So we have to see in our this conditions which exchange rate will be considering. So it is for buying. So the RBI exchange rate is 61 rupees. So 62 minus 61, the differential of 1 rupee into 100 USD. So into 100. So on this value the GST is calculated. So the 99% which comes to 9 rupees. So what is the second condition in the question again? How much GST liable to pay in case RBI reference rate is not available? So we suppose this RBI rate is not there. So how we have to calculate the GST? So what the section rule says, if no RBI reference rate, actual exchange rate is 62 and the USD you need to see, then the taxable supply will be on that value. So see here how much GST difference it comes. So actual exchange rate is 62 and we know it is 1%. So yeah, I am going back to the screen. Please have a look, or in the even in our material, I think somewhere in the page number you can refer our material. The page number is 149. So if you see below, the taxable supply is 62 into what is the USD amount we are converting into 1%. The same we have considered here. So 62 into 100, which comes to 6,200. On 6,200, 1% we need to consider. So it comes to 62 rupees. On 62, what is the GST? 99%. So that is 5.58, and this same is similar to the SGST and CGST. So have a look. Suppose if RBI exchange rate is there, our GST is high, and if there is no RBI exchange rate, then our GST is less. So we have to look in that angle as well. So we have seen in the same problem itself two different cases. So why we are considering the RBI exchange rate, what is the actual exchange rate? So tomorrow if you are going to advise the customer, so on what value he has to pay the GST, and if he is rendering the service of money exchange, then we need to go through these many rules. Now again we are going into case 3. So case 3 is related to cross currency. So what do you mean by cross currency? In this we will come to know about how we are going to calculate in case of cross currency. Royal Financial Corporation, located in Mumbai, being a money exchanger, provided the following service in the month of July 2022 to Infosys Bangalore. Now first condition is US dollar 100 US dollar 1000 is changed into that is UK pound. So 1 pound is US dollar 1.75. The RBI reference rate for that currency at that time, which is $61, that is $1 is 61 rupees and 1 UK pound is 85 rupees. Find the GST liability. So again we are into the 32(2)(a) rule only. So now you will have an idea what is that cross currency. Cross currency means I have $1,000 and I want to convert that into UK pound. So on that day the RBI reference rate US dollar and UK pound is also there. Now what is the GST liability we are going to pay for this type of transactions? First thing, taxable value. So the taxable value is how much? Which is 48,500. 571. So how this 48,000 is derived? So we know it, the UK pound is 571. So that we have already converted $1,000 into UK pound, which is 571.4286. So 571. So the 1 UK pound is how much? 85 rupees. So 571 into 85 we should see. And one more thing is US dollar. US dollar is $1,000, and per in INR if I say it is 61,000. So on these two, whichever is less, that we have to consider into 1%. On that 1% is 486. So if this is related to cross currency, so we need to consider IGST. So IGST, which is 18%. So on 18%, 486 is 87 rupees. So this is the GST amount applicable to pay to the department. So there are under Rule 32(2)(a), we are seeing 3 different cases. In case 1, we have seen if the RBI exchange rate is given. Case 2, we are looking into RBI exchange rate not given. And in case 3, it is fully related to cross currency. So I am rendering some money exchange service to one of the customer. He came and he gave me $1,000 and he asked to give it in UK pound. So this transaction I have rendered during the month. Now I need to understand how much GST if I am doing this type of transaction, then on what value I need to pay the GST. So for this purpose, we need to remember all these rules. So for cross currency, you have to see what is the US dollar as per the RBI reference rate, and for UK pound, what is the that is INR value I am saying, for what is the INR value. So whichever is less, so on that less value 1% we need to consider. On the once you derive that 1% value, then you need to you can calculate the GST amount. So 486 as per this problem, and GST whenever there is some cross currency related, so IGST is applicable. And IGST also not only for the cross currency related, you can see the location, which is very important. The Royal Financial Corporation is located in Mumbai, and they are providing this service to Infosys of Bangalore. So that 2 different states, that is the reason we have IGST applicable for this type of scenarios. So the IGST 18%, which is 87.43. So this is related to the money exchange service. So now we have one more option, which is Rule 32(2)(b). So whenever you see find this type of words like at the option. So at the option means I can opt for the Rule 32(2)(a), or I can go with the option of Rule 32(2)(b). So it is the option of the person who is rendering these types of services. Now for Rule 32(2)(b, I'll go, this is very actually simple. The composite rate 1%, if the gross amount is less than or equal to 1 lakh, the taxable supply for GST is minimum 250 and the maximum 1000. So, and for the gross amount more than 1 lakh, less than or equal to 10 lakhs. So, in that case, what is our taxable supply for GST? If it is more than 10 lakhs, so what is the taxable supply? So, there are three different, and the composites rates are three different are there. So, I think I will share this two problems, because the for 32(2)B in our material is not there, only theoretical it is available. But in this problem we can understand what exactly is about the 32 sub rule 2B. So X Private Limited, a money changer, exchange US dollar 10,000 to Indian rupee 74. That is, Indian rupee is 74 per US dollar. X Private Limited wants value the supply. So instead of rule 32(2)A, they want to follow the rule of 32(2)B. So how in that case, how to value the taxable, how we have to arrive the taxable value of supply. So here in this problem it is given directly, like what the US dollar is 10,000 and Indian rupee is 74. So 74 into 10,000, 7,40,000. So on the 7,40,000 is whether he wants to pay the GST, then it will be not right. So we need to follow what rule says in rule number rule 32(2)B. So we need to remember this, like how we remember our income tax slab rates. Same way you need to remember these as well. So now we will go how in this problem we will see how to calculate the taxable value of supply. So we actually what is there in the flow chart, the same only it is given in the writing also. That is up to 1 lakh rupees. If the currency exchanged is up to 1 lakh, then 1% of the gross amount of currency exchange, or 250 rupees, whichever is higher we need to see. Second case, 1 to 10 lakhs means 1,000 rupees. So 1,000 is how? This 1 lakh into 1%. So 1,000 plus 0.5% of the gross amount of currency exchanged. So here if you see again 5,500. So how 5,500? On 10 lakhs 0.5%. So 5,500 plus 0.1%. So I am going into in depth this transaction. We will see this first two things. Have a look and remember this. So up to 1 lakh, 1% of the gross amount of currency exchanged, or 250 rupees, whichever is higher. So we will see here. So how much a dollar it is? 10,000 into 74. It comes to 7,40,000. So like slab rate, remember up to 1 lakh, what is the value of transaction value of supply? It is 1 lakh into 1%. Because 1 lakh into 1%, that itself comes to 1,000 rupees. So or 250 rupees, whichever is higher, so we consider 1,000 rupees. And now out of this 7,40,000, for 1 lakh, 1,000 we have already considered. So what is the remaining amount? 6,40,000. So which is less than or equal to 10 lakhs. So directly what we are doing? So 0.5% on the gross amount of currency exchange. So on 6,40,000, 0.5%, which comes to 3,200. So the taxable value of supply is 4,200. So on 4,200 only, the X Private Limited, the money exchanger, he will pay the GST. So, suppose this type of questions are asked in our exams. So sometimes what we do, if we are not aware of these types of rules, then directly we say on 10,000 into 74, on that is 7,40,000, the X Private Limited has to pay the GST. So certain rules this types of money, we don't have much things to remember actually. So there are mainly these 5 important are there. In this diagram, if you see, there are 1, 2, 3, 4, 5. These 5 are the different scenarios or different unique type of services these are. So these are very important. Sometimes these types of questions are being asked in our exams. So please remember these 5 services. So we have seen in this, like if that if you know all the values, how you will be calculating the taxable value of supply. If you don't know the transaction value, then we go with the rule 27 to rule 31. So now what we are seeing is, apart from those things, these are some different supplies. So the different supplies means, always remember these 5 heads. That is this is money changing service, travel agent, life insurance business, when we are doing second hand goods, supply of second hand goods, and the last one is redeemable vouchers or stamps or coupon tokens. These redeemable vouchers, you don't want to put more effort because we have already seen in our time value of supply. So these are very simple only. Now we have seen about the money changing services. So even if we are tomorrow, if we are planning to do this type of business, then we should know thoroughly about the GST related. So suppose if we are not aware of these rules, then we may have to pay higher GST amounts. So to avoid these, or even if you are when we are doing any practice, if any of your customer comes with these types of situations, then we should have ready, we should know about which rule to refer. Is there any rules to at least before giving your customer any suggestions, first we need to be thorough. So this money changing services, we have rule 32 2A and rule 32 2B. So even we can advise whether he can go and opt for this rule or 32 2B, which one is beneficial to him. So if he opt rule 32 2A, he can what is the GST amount he has to pay. If he opt for 32 2B, what is the GST amount? So we can compare in our workings and we can give the best judgment to our customer as well. So now after this money exchange services, we have under next service related to travel agent. So in case of travel agents, so how we are going to derive and how we need to calculate on what value the travel agent has to pay the GST. So now the case here is the travel, first we will understand what is the definition as per GST. So the travel agents means they are the mediator between the ultimate customer and the airlines. That is, airlines means example like Make My Trip, that is travel agents are like MakeMyTrip.com, Paytm are examples of air travel agents, because they act as a mediator between the customer and the airline companies. So airline companies like Air India, SpiceJet. So suppose if we are traveling from Pune to Chennai or any other states or any countries, so where we go immediately, we go into checking make my trip. So multiple sites are there. So that exemptions is also there. Air travel agents are not entitled for any exemption, and the payment of tax at the option of air travel agent. So the air travel agents, they are required to pay 18% GST on commission earned from airlines, and also service charges, handling charges, whatever name called, collected from the customers or the passengers. So there is no exemption on whatever amount they are collecting. On that 18% GST is they are liable to pay. There is no bar on air travel agents in availing ITC on input services to support the output services. Or there is one more rule is also there, 32(3), permits air travel agents to discharge GST at a fixed percentage of basic fare, on which commission is normally paid by the airlines. So the effective value and the effective rate of GST is below. So the air travel agent, whether it is a domestic booking or international booking, we have to see two things, whether domestic or international booking. Domestic booking 5% on basic, and international booking is 10% on basic fare. So the air travel agent has to pay GST 18% on the above value of taxable supplies. So ITC is available on the air travel agent, and the air travel agent can pay tax under any of the two options on a transaction to transaction basis. The rule do not bind the travel agent to opt for any of the options uniformly throughout the given financial year. So here in this previous scenario, suppose if you are opting for one, so if you in the financial year, if you are opting for rule 32(2)(a), in the middle you will not be, you should not withdraw, comparing with the 32(2)(b). In 32(2)(b), if I calculate my GST payable is less, so I can, in this April month I pay GST 10,000 because of rule 32(2)(a). If I would have opted for 32(2)(b), my GST payable may be less. So I will change, and I will opt from June month onwards, I will follow rule 32(2)(b). You should not do this. So here the instruction is clearly given. For the financial year, if you have opted the rules, and such option shall not be withdrawn during the remaining part of that financial year. So these are small points only, but very important actually. Suppose even in this particular case, if you are not able to follow also, but one or other way, that will really helps you to understand. So in the money exchange services, if I opt for this particular rule 32(2)(a) from April, then till next that is 31st March, our financial year, I have to go with that rule only. But in this travel agent, it is not like that. So as and when how you want to change, There are you as per our decision we can change it. So there are two cases. So 18% GST on commission earned from airlines, and another one is there is a domestic booking 5%, international booking you have 10%. On the value of taxable supplies. So how we are going to calculate that we will see now. So the summary of the same. Air travel agent. So the GST on basic fare opted. So whether you have opted the basic fare, yes, then you should go with the rule 32(3). Rule 32(3) means you will have pay GST on basic fare 0.9% for domestic and 1.8 for international booking. So if you have not opted on the basic fare, then you need to pay GST on the entire 18% on commission. So what is the basic fare opted, or what is that we will see here. Compute the GST liability of Mr. A. Mr. A, he is a air travel agent. So now we are into rule 32 sub rule 3. We are into this air travel agent only. So here Mr. A is an air travel agent using the following details. Basic airfare collected 50 lakhs, that is for domestic, and international airfare collected, he has collected 80 lakhs. So the commission which he received from the airlines 4,50,000. Year ending bonus received from the airlines, which is 50,000. So now we need to see, say on what value the Mr. A has to pay the GST. Below it is clearly mentioned, in the above case would the liability of Mr. A be reduced if he opts for the special provision for payment of GST, that is rule 32(3). The applicable rate is 18%. So we are calculating, we are seeing both the options. We are going to work on both the options, and we have to give him the best one, where whether he can go with the 32(3) or he can go with the total commission 18%. So now the airlines on the domestic and international tickets. So the commission received from the airlines. So 4,50,000 and 50,000 is the year end bonus. So these two are there. On these two, the taxable supply of services. So adding 4,50,000 plus 50,000, we are deriving the taxable supply of services 5 lakhs. So on 5 lakhs, we are calculating the GST 18%, which comes to 90,000. So this is one option. Now we are going into the second option. So if you see here, we are on this same only. So pay GST 18% on commission. Now what we have seen here is exactly the same. So on commission, and he receives the bonus, this 5 lakhs is the taxable value of supply. So on that 90,000, as per if he go with this formula, he has to pay GST of 90,000. Now we are going into the second rule, that is we are following the rule. Basic airfare. So for domestic booking 50,000 or 50 lakhs. So the domestic booking, how much is the GST, pay GST on basic fare 0.9%, and for international bookings 1.8%. So on 50 lakhs 5% and on 80 lakhs 10 percentage, and that we have 2,50,000 and 8 lakhs here. So how much is his taxable value of supply? His taxable value of supply comes to 10,50,000. That is the GST on 10,50,000. Now we will be calculating the GST. So what is the GST percentage? It's already given in the problem, which is 18%. So if we follow the rule 32(3), then he has to pay the GST of 1,89,000. So what we have to suggest Mr. A, we have to advise him, the special provision of rule 32(3) is not economical for him. He can go and opt for this rule. So on total commission, he can pay 18% GST, and if he go and opt for this rule, that is domestic booking separately and international booking separately, if you are calculating the commission 5% and 10%, then in that case you have to pay higher GST. So we need to conclude that he can go with this option of paying GST on the total commission, and he don't want to opt for this rule 32(3). Then we were seeing 5 different services in this this flow chart. We are seeing 5 different services. The first one we have seen is the money changing service. Now we have seen about the air travel agent. So in air travel agent also we have seen on total commission, if he pays GST, what is his payable, GST payable, and if he opt for rule 32(3), so what is the domestic fare and what is the international commission he receives. On that, if the GST is calculated, what is the GST payable to the department. So which one is more economical for the travel agents, that we have seen in the travel agent. Now we are into the life insurance business. So for the life insurance related companies, how they have to pay the GST, on what value the GST has to be calculated. So now we are into the life insurance business. So only one thing we need to remember here, we know under valuation chapter what are the topics are there. So when we see apart from this rule 27 to 31, there are other different supplies also there, and we will prepare a short summary of it and have a look on those slab rates or what is the rule given. So we just have a look on those rules, like up to 1 lakh means what is the commission, or up 1 to 10 lakhs means what is the rate. So those things we need to remember here. Now we are into the life insurance company. So based on this chart given, I'll just explain. Then again, like previous one, we will have a look on the problems. Services of life insurance company, rule 32(4). So there are two things again here, where the premium covers only risk. So only risk means pay GST on the gross premium. So very simple, if the premium covers only risk, we need to pay GST 18% on the gross premium. Now the difficult part here is when the premium covers both risk and savings. In that scenario, how we need to calculate the taxable value. So, so taxable value means uh, from previous class we have been discussed, sir, like a tax in direct tax, how we are calculating the taxable income. So in the indirect tax also we call it as a transaction value or taxable value. So on that value only the GST has to be paid. So that's why the taxable value is very important here. So the entire valuation chapter is about how to derive the transaction or the taxable value only. So since you were not there, I am just giving some little background of what exactly this valuation chapter is. I think even in inter it is we have not covered this much in the inter. In inter it is only few area only, like 15 where for all the transactions where all the numbers are there. So it was very simple in inter area, but in our final we have in detail or in depth into all areas here. So for the life insurance company, we are seeing two things, where the premium covers only risk and premium covers risk and savings. So here if risk and savings means the amount allocated for savings has been intimated to policy holders at the time of providing service. So what is the so the premium amount, from the premium they take some little amount for the savings. So in that savings, if already informed, in that case the gross premium less savings and we derive the net premium here. So on the net premium 18% GST will be calculated. So the savings amount is not intimated in that case. So we have 32(4)(b) and 32(4)(c). So 32(4)(b) is about single premium annually 10% of the single premium annuity. 10% of the premium is the taxable value. So else we have to follow 32(4)(c). So 25% of the first year premium is taxable value and 12.5% of the subsequent years premium is the taxable value. So immediately we may not, I agree, like immediately we may not able to remember everything, but try and put some effort to understand, like in the life insurance business. So just remember the life insurance business means what? Immediately it comes to our mind about the premium only. So along with the premium, sometimes out of the premium amount the insurance company from the premium amount you may not be knowing, but suppose if some portion of the percentage amount they keep it in our savings, or you can call it as an investment, and remaining in the premium and the balance as an administration fee. So the premium amount means it is not wholly part of our sum insured. If you see the premium paid on the insurance part, some percentage goes to savings if we have opted for this type of premiums only. So certain percentage they do that savings, and then premium, and then adjustment for their administration fees they deduct it. So if that savings amount is intimated, then single premium annuity 10% of the premium is the taxable value. If no, then we go with this rule. 25% of the first year premium is taxable value, and for the subsequent years 12.5% is the taxable value. So now we'll see with the problems, and then you will have some idea about what I am just trying to explain. Arihant Life Insurance Company started its operations 22-23. So during the year has charged gross premium 180 lakhs from policy holders with respect to life insurance policies, out of which 100 lakhs allocated for investment, 100 lakhs allocated for investment on behalf of the policy holders. Compute the GST liability, that is rule 32 sub rule 4. So now we are going to follow this rule now. So we know it, their premium, that is the gross premium during the financial year is 180 lakhs, and how much has been allocated for investment is 100 lakhs. So now how much, on what value is their taxable value of supply, that is on what value they have to pay the GST. Is that on 180 less 100, on 80 lakhs are they going to pay, and how we are going to derive? So for that we need to refer rule 32 sub rule 4. So compute the GST liability. So first question we will try to solve. If the amount allocated for investment intimated to the policy holders at the time of providing service. So go back to this chart. Yes, that has been intimated to the policy holders. Then gross premium less savings, you will get the net premium. So coming back, so you have gross premium 180 less savings, and you have the amount derived as the 180 minus 100 into 18%. So we get 14.4 lakhs. So this is the first case. So now we will move on to the second different case. So the investment not intimated to the policy holders at the time of providing service. So if it is not intimated, so in that case, so again we have to see this rule now. Rule 32 4b or rule 32 4c. We have to see now. 25% of the first year premium is the value of taxable supply. So we are if the amount for investment not intimated to the policy holders at the time of providing the service. So it is the first year premium, 25% is the value of taxable supply. GST liability being first years of operation, being it is the first year, will be computed like 180 on 180 lakhs, 25% premium, so it comes to 45 lakhs. On 45 lakhs, 18% GST is derived. Now the last scenario is if the gross premium charged only towards risk. So only towards risk, we know it, there is no savings, entire 180 lakhs, on that 18%, so 32.4 lakhs. So these are very simple to, so only thing is we need to understand this flow chart, and on this we can, it is easy for us to calculate here. Here there is no not kind of annuity and all, it is only just started and it is a first year related. So now in this, if you see the first question, the first one is the same, the amount allocated for savings has been intimated to the policy holders. So if intimated, what we have to do? Premium less savings, net premium, on net premium 18%. Very easy one. Now the second case, if the amount allocated not intimated at the time of providing service. So being this is the first year only, because it has started its operation in the year 20 to 23. So what in that scenario, as per rule 32 4C, 25% of the first year premium is taxable value. So on directly how we are calculating, 180 lakhs on that 25 percentage, so 45 lakhs. On 45 lakhs, 18% is the GST. And the third scenario is if the premium covers only risk. So risk only means we have 180 lakhs and we should not consider this savings. Directly on 180 lakhs, 18% GST, so 32.4 lakhs. You can see the GST payable amount in the three different situations. So that will be our analysis. So if the insurance company shows this, or you can also advise the insurance companies, if you are doing any percentage of savings, then you can deduct that savings and then on the balance you can pay the GST. So you will not end up with higher GST. These types of suggestions also we can give. But for that we need to have a look on these many rules which are very important. So now next scenario we are into LIC, the same related example only. LIC of India provides you the following information. You are required to compute GST payable, opted to pay GST 32(4), rule 32(4). So first one is general policies, second one only risk cover policies, third one variable insurance policies. So first one general policy, total premium collected is 12,000 lakhs, out of which first year premium 5,000 lakhs. And the risk cover policies is, there is a risk cover policy means you should immediately remember about this chart. So premium covers only risk and we have premium covers risk plus savings. So only risk cover policies is there. Second, the last scenario is variable insurance policies. Premium collected 8,000 lakhs. So 80% is allocated for investment on behalf of the policy holder, for which policy holder given separate breakup in the premium receipts. So now we need to cover. So LIC which has three different scenarios. So now we need to work and give them what is the GST amount the LIC has to pay. So now we will go with line by line now. So first one is what? General policy is there. So on that total premium is 12,000 and the breakup also it is given. First year premium is 5,000. So first year premium means we should immediately go with this option. So first year premium 25% and for the subsequent years which is 12.5%. So first year 5,000 and 7,000, this is the breakup, and the premium amount also 25 and 12.5. Then the second one, only risk cover policies. So the premium collected is 500 lakhs. So we are considering directly. Why we are considering the entire 500 lakhs? The rule clearly says if the premium covers only risk, then you need to pay GST on the gross premium charged. So here how much is the premium amount? Only risk policies 500 lakhs. So we are considering directly the 500 lakhs. Now we are going into the third situation. Premium collected is 8,000 and we know it 80% is allocated for investment. So 8,000 less 8,000 into 80 percentage, which comes to 6,400. So the net premium amount only we need to consider for the taxable value. So the all three we have covered here. The total is 4,225. On that we need to calculate the GST here. So on the whole, what is important here is please remember these conditions. So these are very easy and simple only. So remember the premium covers only risk. Remember premium covers risk plus savings. So if savings is there, so on the total premium deduct the savings and then you can continue calculating for the GST amount. So first year means 25% of the premium, and for the subsequent years means 12.5%. Okay. So now another interesting topic is buying and selling of second hand goods. So now suppose I am going to do this business like buying and selling the second hand goods. In that case, how I on what value I have to pay the GST? So that is important to understand here. So where a taxable supply, again I will show with this flow chart. Very this will be easy to understand. So the we have buying and selling of second hand goods, and we are into rule number 32 sub rule 5. The goods are repossessed from a defaulting borrower who is not registered. The valuation topic little bit we need to understand everything. So please focus. So the goods are repossessed from a defaulting borrower who is not registered. So what happens? I have taken a new car in the month of January. So I continuously paid all my monthly installment and I did not pay for last 3-4 months. So what the company did, they have considered as I am a default borrower, so they repossessed the car from me. So there are two things again in this repossessed the goods from a defaulting borrower who is not registered. So not registered, yes, in that case how we need to calculate? If no, in that scenario what actions we need to take? If yes, that is I am not a registered person, then the purchase value less 5% per quarter from the date of purchase to the date of disposal. Then purchase price of the borrower. So we need to see the 5% per quarter which I have told is very important here. So 5% per quarter from the date of purchase to the date of disposal. Then we derive the purchase price of the borrower. Then GST will be levied on the margin, that is sale value less purchase value. If there is a negative value, then GST, no GST. So same case for the other things also. Like if I am a registered person, then what I would have done, I might have taken the input tax credit. So in that case, if input tax ITC is taken, then in that scenario sale value, that is transaction value only, sale value is the transaction value and the GST will be levied on the transaction value. Okay, I am a registered person, but I have not availed the ITC. So in that case, sale value less purchase value, then your margin is there. On that we need to calculate the GST. GST will be levied on the margin. So suppose my sale value is 100 and my purchase value is 200. So that time it goes into a negative margin. If it is a negative margin, then my GST is 0. Nothing. I am not liable to pay GST in case of negative margin. So here the quarter means. So have a look. Quarter shall means a period comprising 3 consecutive calendar months ending on the last day of March, June, September and December of a calendar year. So the quarter definition is there. So we will see some simple problems. Now, Ram and Co. being a car dealer, suppose any doubt ping me, because even if you speak it, I am able to hear very low voice. Voice is not clear also. So if you ping me so that I can have a look and explain you again, no issues. So till now we are into the valuation chapter and we are looking into the rules of other certain supplies, because apart from rule 27 to 31 there are other services are there. For the other services, how we are going to calculate the taxable value, that we are looking into it. So now in this second hand dealing of buying and selling of goods. So Ram and Co. being a car dealer dealing in second hand cars. Ram and Co. purchases used car from Mr. Raja and sell the very same car to Rani after water wash and painting. The purchase price is 2 lakh, whereas the sale price is 2,50,000. So from this itself we are clear, there is a positive margin, there is no negative margin here. So second, and then the final, the GST liability is, we need to consider, it is given 28%. Ram and Co. not availing ITC on purchase of second hand cars. So they are not going to avail the ITC. Whether your answer is different, if the sale of second hand car for 1,80,000. See, my purchase price is 2 lakh and my sale price is 1,80,000. So it is going to be a negative margin. Yes. If your answer is going to be different, yes, it will be different, because it's a negative margin. I am not liable to pay the GST. So now note Ram and Co. and Miss Rani located within the state of Tamil Nadu. So if it is that given, so CGST, SGST is applicable. Now we'll go step by step. So the sale is 2,50,000 and the purchase price is 2 lakh. The difference is 50,000. So on 50,000, the GST is 28%. It is given. So CGST, SGST 14%. And then it's very simple problem only. So we have shown here. Then second case is the sale price is 1,80,000. Then we have a negative margin. In that case, GST is nil. For a dealer who has opted the margin scheme, who has opted for the margin scheme, there can be a scenario second hand goods sold at a zero margin or price as a less. In this case, no GST will be applicable on the supply. So that's a direct one. So now we will see any sums with the date of disposal and the quarters are there. Okay. So we'll quickly have a look on this illustration 28. Mr. D, being a dealer in goods, sells new brand cars at 11 lakhs. He advertises that customer can sell their old car if they buy new car from him. One customer exchanged his old car for 2 lakhs. Mr. D sold a new car to that customer for 9 lakhs. The Central Tax Department demanded to pay GST 11 lakhs, whereas D argues he is eligible to pay GST on the difference, namely margin of 9 lakhs as per rule 32 sub rule 5. Discuss and decide the correct approach. So now we need to give the advice, so whether this is right or what action is required. So rule 32 sub rule 5 is applicable only when person is selling, buying, that is person is dealing in buying and selling of second hand goods. In this case, D is not eligible for margin scheme since a dealer sold new car, and therefore this provision will not apply, and the department view is correct. So this is the this problem has been asked, I think, in one our final year exam. So please have a look on these types of problems also. So rule 32 sub rule 5 is about the buying and selling of second hand goods. So for our tax, each and every word is important. From this you will have a definitely clear that. So it is rule 32 sub rule 5 is buying and selling of second hand goods. So in this they have mentioned that dealer sells new brand cars. So and they also paid GST on the 9 lakhs instead of 11 lakhs. So when department has argued that it should be on entire 11 lakhs, so whether their department approach is right or wrong, we are giving the our justification. So means department view is correct. Why? That rule is applicable only for the dealer who is dealing in the second hand goods and not for Mr. D. So Mr. D, though he has sold the vehicle for 9 lakhs, he has to pay GST on entire 11 lakhs. Here the taxable value of supply is 11 and not 9. So this is the reason why we are learning the valuation in our this final. So sometimes what we do, we may also consider this 9 lakhs only because your invoice value is 9 lakhs, so you need to pay on the 9 lakhs. No, you need to mention clearly this 11. On 11 you pay the GST, but when you are selling, you are deducting this, or you need to raise a credit note separately and you adjust, and you need to show that net receivable from this Mr. D is 9 lakhs. So there will not be any RICO issue in the books as well. So now we have not seen from the date that 5% how to calculate it. I am not sure whether we have it or not. Sure, we will see here. Mrs. X Limited, a registered person dealing with second hand goods. X supplies a used camera to a consumer in Chennai, selling price is 15,000. The used camera, that is second hand, was purchased for 10,000 from a dealer in Mumbai. CGST, SGST 1,400 each was charged. X Limited charged IGST 28% on interstate supply. Find net GST liability if ITC availed and ITC not availed. So how we have to present this? So the supply is 15,000 and less ITC, that ITC comes to 10,000. So on that, what is the GST? The 28% GST we have, and ITC is 14%. That is directly given in the problem, 1,400 and 1,400, which the net GST liability comes to 1,400. So if ITC is availed, the second scenario is ITC not availed. So when ITC is not availed, so what is our sale price, which is for 15,000, and the used camera was purchased for 10,000, on which CGST, SGST was charged, that is 28% is already included here. So the GST will form part of the cost. So if you are not availing, that is if you are not taking the ITC benefit, so then that will be your cost. So then 12,800 it is. So the margin comes to 2,200. On 2,200, the GST is 28%. So see the two different, for the same case, if ITC, in case ITC availed, what is your GST liability is there. In case if you are not availing the ITC, what is the GST we need to pay to the department. We have, whenever you have any suggestion, even when you are working in any organization or doing your practice, analyze two different scenarios and show which one is beneficial to the customer. So here, when you are seeing the first scenario, if you are availing the input tax credit, in that case the GST he has to pay 1,400, and in case if he is not availing the benefit of GST, in that case he is having 616 only as a GST liability. So now we are moving into the same only, dealing with second hand goods, but here we are seeing about the this percentage as well, that is what is the purchase value and the 5% that per quarter, these thing. So we need to see, right, what is the 5% per quarter. So if it is 3-4 quarters are there, how we are going to calculate the percentage. So for that we are seeing a simple example, this thing. Yes, Mr. C has taken a loan from bank July 15th, 2017, and 2 crore worth, that loan amount is 2 crore, and he purchased a machine. Mr. C defaulted in paying the loan along with interest. Subsequently, bank repossessed the machine from Mr. C. So they have taken the goods from he is a default borrower, so they repossessed it. The banker sells the goods on 26th April. So the date of disposal is 26th April. So now Find the value of taxable supply in the hands of banker. Case 1, case 2 we have machine sold, and if the machine is sold for 1,90,000, if the machine is sold for 1,70,000, what is our applicable rate of GST? We have to see here. So the purchase value, what is the loan amount? That is 2 crore, and the purchase value for the lending company, the purchase price is 2 crores. He has taken a loan worth 2 crore and purchased a machine. So whether it's a loan or we are seeing the purchase value only. So you can see here in this simplified approach the same purchase value. So the purchase value is 2 crore and less 5% per quarter. Yes. Here subsequently the bank repossessed from machine from 1st of Jan 2018, and the goods was so disposal is 26th April. So till 31st March 1 quarter, and the second quarter is also started, that is 26th April. So 5% plus 5%, 10%, so 5% per quarter, and the second quarter is started, total 10% here. So on 2 crore, 10% is 20 lakhs. So this is the purchase value at the time of disposal by the bank. So we derived the new purchase value at the time of this, which is 1.8 crores. So now we have two cases, case 1 and case 2. So the case 1 here is so if the machine value is 1 crore 90 and the machine value is 1 crore 70. So what will be our taxable value? So if the machine value is 1 crore 90 and we derived a new purchase value, so which is 1 crore 80 lakhs. So the taxable value 10 lakhs. On 10 lakhs we have to pay GST of 1,80,000. So who has to pay the GST? The bank will pay the GST of on this. And then if the machine is sold for 1 crore 70 lakhs and our new purchase price is 1 crore 80. So on 1 crore 80 means we have a negative margin here. So the GST is nil. So there are two scenarios we are seeing in case 1 and case 2. What we can call this 1 crore 80, which is the new, we are deriving new purchase price, means the originally the machine the loan or the purchase value of the machine is 2 crore and we are deducting 5% per quarter from the date of purchase, that is taken date of repossessed till the date of disposal. So the 2 quarters 5% per quarter. So it is not like till 30th June only we need to consider 5%. The second quarter is already started. So 31st March 5% and 26th April is date of disposal. So the 5% for the next quarter. So totally 10% it is. So on 2 crore 10% is 20 lakhs. We have derived the new purchase value and the sale price, it is already given in the question, and we are deducting new purchase value and then we are calculating the taxable value of supply. So this is for the buying and selling of second hand goods. Then redeemable vouchers or coupons, this we have already seen in the time value of supply. We will see the directly the illustrations, simple examples here. So voucher has face value 5,000. The holder can purchase goods equivalent to 5,000. When the holder of voucher receives the goods against the voucher, it is termed as redemption of voucher. So here the example is X Limited, a cloth merchant, sold a gift voucher to customer 2,000 on 10th November to purchase specific cloth from its showroom. Goods value, goods actually purchased by customer on 15th November. So find the time value, time of supply and the value of supply. So if you all remember, the actually the goods purchased on 15th November, but 15th November we should not consider. If you know the goods which they are going to purchase using the coupon, so he has given here on 10th November to purchase specific cloth from its showroom. So when we have seen in the time value of supply, if you know what exactly the coupon is given and their customer is going to purchase, then the time value is 10th of November. So I have given some coupon where the customer can purchase electrical items or clothes or any groceries also. In that case, when the actual redemption happens, that is the time of supply. So that time you can consider 15th November. But for this cases, you know it, you have given the customer to purchase specific cloth from its showroom. You know the customer is going to purchase the cloth only. So in that case, the time value is 10th of November. And the value of supply 2,000 for the gift voucher. So, okay, the next scenario, I think what I told, that same scenario here. Ram & Co, dealer in electronic and electrical items, issued a gift voucher to customer 2,000 on 15th of November. Customer can use gift voucher to purchase anything which is available. So you are not sure he is going to purchase only television, only refrigerator. No, the shop is electronic and electrical items. He may buy laptops, he may buy mobile, or he may buy whatever available like television or whatever, microwave oven, whatever electronic items. So in that case, the customer purchased goods worth 1,400 on 20th of November. Here the time value is not 15th November because we are not known what the customer is actually going to purchase. So the time of supply is 20th of November and the value of supply here is 1,400. So the GST liability on 1,400, you calculate 99%. So that's our GST here. I think we'll quickly see this problem also and then we will close for the day. Mr. and Mrs. Kapoor purchased 10 gift vouchers, 500 from Crossword and 5 vouchers from a reputed spa costing 1,000 each. The vouchers from a reputed spa had a special offer for couples wherein services for both persons at the price chargeable to one. Find the value of supply. So the 10 gift 500 rupees. So it is for the 5,000 is from the Crossword value. And then 5 vouchers and that is for 1,000, that is for the reputed spa, that is 1,000 rupees each. So that is 5 vouchers 1,000 each, which comes to 10,000. This is just a simple simple calculation of how we are, what is the taxable value. So first one is for the crossword we have, and we have reputed spa also. If it is crossword, 10 gift, 500 is 10 into 500, 5,000. For the reputed spa, how 5 vouchers into 1,000, and this 1,000 rupees for each, they have clearly given each, and the vouchers for the had a special offer for the couples. So into 2 we are doing here, so it is 10,000 rupees. So we have seen all these 5 which is very important, but still we have pure agent we need to see. So pure agent we will see in the next class. Before that, just want to update, actually planned for the duty drawback portion also. I am not going to give go in detail, just will share you the screen. So you might have come across in the organization also related to the duty drawback. Just like a background, just for like a summary, if I want to give you, I will share some 2-3 things. So whenever before next class, you have some time to have a look on duty drawback, you can have a look on these points which are very important. So in the duty drawback means, this duty drawback we will be studying only related to the import goods. So duty drawback meaning itself is for the import. When we are importing any goods or any materials, we pay duty, import duty. So we are using that material and manufacturing some product ABC, and you are again selling, exporting that product ABC. So that time when we are doing the export, you can claim the duty amount, that we call it as a duty drawback. So there are 2 things which is very important here, like you are importing product XYZ, and using that XYZ you are manufacturing a product ABC, and that ABC you are exporting. So at the time of export, you can submit the documents related to XYZ used for the manufacturing of ABC, and you can claim the duty amount. So that is duty drawback. We will be studying in depth. Just as a summary, whenever you have some time before next class, have a look. So it will be easy also to discuss in our class. There are two types of duty drawback is there. One is special brand rate of duty drawback, and another one is all industry rates. So in all industry rates, it is on every notification from the department which has been already or predefined, that if you are importing this product and you are going to manufacturing using that product, you will be getting a drawback percentage as 10% or 15%. So it is already predefined. So what is special brand, that special brand rate? Suppose the import material what we are importing, which is not there in the all industry rates, which is not covered, and the percentage which is mentioned in the all industry rate is very less. So in that case, we go and opt for the special brand rate of duty drawback. So these are the conditions are there in the special brand rate of duty drawback. Like exporter has to apply for fixation of special brand rate of duty within 30 days from the date of export. suppose if I am not okay with this all industry rates, or in the all industry rate the drawback percentage given is very less, so I am not agreeing with that. So within 30 days I need to submit the my documents with the department. All industry rates do not cover 80% of the duties paid by the exporter, and rate of duty drawback should not less than 1% of FOB. This 3 and 4th point a little difficult, but when we solve the problems it is very simple. Then exported goods value is more than the imported goods. So in the under these criteria we will be using special brand rate of duty drawback instead of going into all industry rates. So this like this only we will be seeing our duty drawback chapters. So when you have some time, not everything, at least please remember this the one which you are seeing now in the screen. Have a look on this, and in the valuation we have seen some other different topics like the 5 major other supplies. So these are also very important. So have a look on these topics, and we will see in our next class the remaining part and the duty drawback areas as well. And any doubt or anything required, please reach me. And Anu, if you want to leave, you may leave. I will be asking Rajaram sir related to what whether he is able to follow or where I should improve. What I have asked with you yesterday. So you may please drop, or whatever help you need, you can reach me, Anu. Yeah. Thank you. Good night. Rajaram sir, yesterday I was asking Rakesh and Anu the same only. Suppose if you are not able to follow, or where I need to add any more examples, or add any few points, or what your suggestions is there, you can let me know, sir. Because previously you were joining, and I have not seen you long time in our class. So that's why whether you could be able to follow, or what your requirement, sir, anything you want to add or something you want to suggest, please let me know, sir. Because even yeah, sorry that not for joining and all. So I was just asking whether you find any difficulty in following my lectures, or I am going very fast or very slow, or these things. Okay, sure, sir. No problem. I told even Anu and Rakesh also yesterday. So whatever help or any support required, you can reach me on Teams or during the class hours, or you can reach me on WhatsApp. Our group is there, so you can reach any time. We will solve, and you will be giving in this June, no sir, this June, coming June, no. So only 2 months only hardly is there. So we have to see how much we could be able to cover, and whenever you feel you are available, I am available after 7:30 or 8 every day. So if you need any help, please reach me, and I can whatever help or support from my side I can give you, sir. Yeah, thank you. Good night, sir. Sure. Yeah, in this session, if you have any doubt, no sir, you can reach me, and whatever support required, I'll give you, sir. Thank you. Good night, sir. Yeah.